You are listening to Keystone's Stock Talk Show, episode 211.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
Okay, I want to say this week myself and Aaron are going to be presenting at the Money Show, the Canadian virtual event. So those presentations will be myself Wednesday, May 17th at 4:35 p.m. and to 5:05 p.m. Eastern Time. That's 1:35 to 2:05 Pacific Time. Aaron's will be Thursday, May 18th at 1:35 to 2:05 Eastern Time. And that is 10:35 to 11:05 Pacific Time. I will be talking about basically four cash producing stocks, really that you can find nowhere else to put in your portfolio. If you want to get access to that, sign up to the podcast and we'll send you off an email of where you can directly get access to that. That'll come out to anybody who signed up to our podcast, and you'll get access to that. We'll also send out an email out to all of our current clients and current subscribers to this podcast as well. Aaron, do you know what you'll be talking about?
Yeah, so what I'm going to do is I'm going to talk about essentially the principles of building a portfolio by combining some great dividend growth stocks with some higher growth, more exciting themes and technology. And that's going to include generative AI stuff that's aligned with ChatGPT. So the idea here is that, you don't have to just be a conservative dividend investor. You don't have to just be somebody who's chasing the most exciting stocks. There are ways of building a portfolio where you use solid dividend growth stocks as a foundation for that portfolio, and then you augment the return of your portfolio by adding layers of risk and some more exciting higher growth names. So that's what we're going to talk about, those principles, avoiding some of the common pitfalls that investors get caught in. And then I'm going to have four recommendations for companies at the end that really, highlight what we talk about throughout the presentation.
We might even open up a Q&A session after those that you'll get a link to those, or we'll tell you in the presentations where you can link back to our website and watch them. But they're the virtual Money Show. You can sign up at the Money Show, www.moneyshow.com. Is that what it is? I hope. That's what I'm hoping. But you, if you want to subscribe to this podcast, we'll send you out the information on that. It's great to be back with you again this week. We have a busy show this week with four Your Stock Our Takes. More listeners equals more questions, I assume. I will kick them off with a look at Hamilton Thorne Limited, symbol HTL, and the TSX Venture, a provider of precision instruments, consumables, software, and as services that reduce cost, increase productivity, improve results, and enable breakthroughs in assisted reproductive technologies, research, cell biology markets as well. The stock is historically cash flow positive and recently posted solid organic growth. But is it translating into solid cash flow per share? I will let you know. Aaron will answer a listener question on Palantir Technology, symbol PLTR, on the New York Stock Exchange. It builds and deploys software platforms for the intelligence community in the U.S. to assist in counterterrorism investigations and operations. The company provides Palantir Gotham, a software platform which enables users to identify patterns hidden deep within data sets. Aaron lets you know if this stock should find a place as a Batman-style anti-hero in your portfolio. Brennan, what's his name? Brennan? I don't even know. Brennan answers a listener question on Alexandria Real Estate Equities, symbol ARE, on the New York Stock Exchange, an office REIT focusing primarily on the life science and biotech markets. The stock has been cut in half basically year to date from its high of approximately $225 per share. Is there an opportunity here, or is it a falling knife? Brennan will take a look. Finally, Brett reviews a viewer question on 23andMe, symbol ME or me on the NASDAQ, a consumer genetics and research company. Brett will let you know if the company has isolated the stock picker's gene, but more importantly, whether or not 23andMe should be part of your portfolio. All right, I'm going to welcome Aaron and our co-hosts here, Brett and Brennan, the Killer Bees. How are you guys doing?
Well.
Welcome.
Have good weekends, or what did you get
Mother's
up to?
Day.
Anything
Mother's
huge?
Day weekend, so
Happy Mother's Day. It's true.
yeah.
Donna, if you're listening,
Happy Mother's Day.
Happy Mother's Day. You're the greatest.
Amazing mothers.
Yep.
It's true. It's true. And to Candace, too.
Wow.
Oh, God. But I know she's not listening. That's the thing. So it doesn't really matter. It's great. Anyways, no, yeah, we had a good weekend. Good Mother's Day over there, Aaron.
Yeah, it was good. It was good. I just keep myself busy, right? Because I got to make sure that I handle everything, which is a good
Don't screw up, basically.
What I do is I make the day as easy as possible.
That sounds good.
She appreciates.
And you guys, did you spend time with the moms?
I did not. My parents are going to come down to Saskatoon next weekend, and we're going to celebrate kind of Mother's Day and my birthday and Everett, which is my brother-in-law's birthday as well.
You didn't see your mom on Mother's Day?
I mean, she lives an hour and a bit away, and I had to drive. I would have had to drive.
That's way.
I
too
called
far.
her. We exchanged some tears on the phone, and I told her how
because you didn't show up.
No. It's because I told her how I wouldn't be here without her. Anyways, Brett,
that would be true of all of us.
Did you talk to your mom, Brett?
Let's get away from me. Brett says I got nothing to say.
No, I will say. So my brother has had a little wiener dog that's about 7 years old now, and we have a little puppy that's about 6 months, and they finally got a meet up after this time, which they've been wanting to. My mom was all extremely happy about how they actually got along, because they briefly met when she was about a couple months old, and did not get along. So it's been a big turnaround for them, and I'm pretty sure that dog is her favorite child now. So
yeah,
it's quite important.
Well, who gets along more, the dogs or you and your brother?
The dogs, I'm pretty sure. They're with how they were going, it's hard to beat. So I don't think
good.
Yeah.
Yeah. Well, like I said, we have a puppy in the house now, and socializing them is huge, right? Mm-hmm. Getting them actually. Yeah. So she's out there trying to tackle every dog on the street and at the beach.
I was at the dog park.
It's good times.
Yeah. I didn't bring a dog, but I was just there.
Should we explore that, or should we just move on? We have no idea why. Did you bring a cat?
No, I was there with friends. There's a beach along the river, so I was there.
This is the last thing I'll say about my weekend. We were at we went up to this Harrison Hot Springs, a place, and there's a lake there. So you're at a beach, and I had lunch. So you have to find, now that you have a dog, you got to find dog friendly places to go, right?
Totally.
So we went in this place that was really good, actually. Had 8 in there, but there was about 6 or 7 dogs in there. And then in walks these 2 people with cats on their backs. They had cat backpacks, but they're on leashes, but on their back, just walking in. They sit down. They sit on these chairs right next to us. And our dog has a loud bark, and the dog barks, and the cats just sit there. Don't even move once. Everybody was amazed. There's people taking pictures, and it was pretty cool. Maybe I'll put up a picture of that. I think we have a picture, so we'll put up a picture of that so people can see, because everybody I know wants to see these cats sitting there. But that was part of the cat weekend. Brennan, you could be the same as those people.
Awesome. Nice trip to the lake there with the dog.
Yeah, we went up to Sasquatch Mountain to look at some properties. There was no one up there. Yeah, the dog, it was awesome. Yeah, my love of the dog. Of course I loved it up there.
Before we move on, can I just say one last thing? It is sad.
No.
The Oilers got knocked out of the playoffs.
Or I'm extremely happy.
Yeah,
one of the
depends, but
look, the Leafs are out too. So there's no it's been 30 years, no Canadian Stanley Cup champion over that period. So I mean, the Canucks, we don't even enter the conversation. So I mean, I can make fun of every other team because honestly, the Canucks have been the worst Canadian franchise, at least in my opinion, for about 11 years.
But they're the last Canadian team that's made it to the final. Is that
No, the Canadians made it in
right,
in the bubble. I don't know if we really even count that. There was an all Canadian division. It was strange, but I mean, Canadian fans out there, we can count that. It's true. But yeah, I mean, the last that got close.
Yeah, a little different that year.
Yeah. All right, let's move on. Let's actually get to stocks. I think that's what people want to actually hear about. I'm going to start with Your Stock, Our Take listener question or viewer question on Hamilton Thorne Limited, symbol HTL on the TSX Venture, trades around $1.63, $237 million market cap. The company sells lab equipment, consumables, software, and services primarily to the global assisted reproductive technology industry, which captures in vitro fertilization. Hamilton Thorne sells the portfolio branded and third-party offerings on a global basis through direct sales and distributors. So let's start by looking at the balance sheet here. The company has around $15.85 million in cash as at its last period, $16.97 in debt. So net debt is just over $1 million. So pretty solid balance sheet, relatively speaking. They just released their first quarter 2023 results. Sales increased 19% to $16.7 million. And first quarter adjusted EBITDA was up 13% to $2.8 million. Now, organic sales were up 15%, which is great to see. The organic growth, was up 15%. And net income, however, decreased to just $77,000 for the quarter. Cash used in operations in the quarter was about 142 in that range, thousand. So the company has been historically cash flow positive, and this should be the case over the remainder of 2023. But even taking last year's operating cash flow, which was 1.8 million, the company would then trade at around 132 times cash flow. Now, 2022 cash flow was depressed. So if we go back to 2021 on an operating cash flow basis, if we see what it's trading at today, it's about 42 times. Historically, the company trades at about 20 to 30 times cash flow. Now, generally here, we look at the share structure of the company. Historically, it has grown via acquisition and has issued shares and used debt to pay for that growth. There is organic growth, like we said in the last quarter, but a big part of the growth has come from acquisitions. This has taken the share count from about 52 million shares in 2014 to 144.8 million shares today. That's almost 3 times higher. Now, Hamilton Thorne is not nearly the worst offender in respect to increasing its share count. It has grown on a per share basis, its cash flow historically, but we do find that most small and mid cap companies that are tremendous performers over the long term, they find a way to provide less dilution as they grow over time. Included in this list of companies that we've recommended in the past that have been tremendously successful and not increased their share count significantly over 5 and 10-year periods would be a company like Expel, Hammond Power, the Boyd Group, and Water Furnace. Names from our coverage that have done 10 times performance, had tremendous growth and limited share dilution over the long term. So that's a general thing that we would like to look for in a business, limiting the dilution that the company provides over the long term. So our take overall on Hamilton Thorne, I see the business as run by competent management in a solid industry that is currently producing strong organic growth, and they're taking market share. The company has a reasonable balance sheet and growth in revenues at a solid pace from 7.9 million in 2013 to about 78.8 million in 2022. Over that time, the stock has performed well, going from 10 cents to $1.63 today. Operating EPS has been a bit more volatile over that period. If you look in 2023, operating income was roughly $400,000. It surged to $5 million in 2018 and 2019, just over, but has failed to return to that level since. 2020 was affected by COVID, but they moved closer to that figure at about 4.8 million in 2021. But in 2022, they declined on an operating income basis to 3.2 or 3.3 million. As we stated to start 2023, cash flow was negative. Operations should continue to normalize and contribute to the negative cash flow turning positive over the course of this year. But there was some one-time items, including timing of increased accounts receivable, reducing accounts payable at the end of the quarter, that did contribute to the 2023 Q1 negative cash flow. Inventories were up slightly as the company begins to unwind significant investments in inventory that were made in 2023. Again, on a positive note, organic growth, which eliminates the effects of both acquisitions and exchange rates, was up 15% for this first quarter, reflecting, again, like we said, continued market share gains. Management has stated they are actively working on multiple acquisition opportunities as well, and they do have the cash on hand to do that and a debt facility that they can tap into. Hamilton Thorne is interesting. It's a good niche player, but the stock currently trades at roughly 90 times EPS and well above historical cash flow multiples. Good business, but expensive until it generates better cash flow.
Right. And what we would want to see from a company like this, which is a small cap, is, we would want to see it trading at a discount to large cap comparables. And this is not at all the case. So, at a valuation, I mean, if you look at analyst expectations for the current year, analysts are looking at about 4 cents in earnings. So that brings them to, I think, about 45 times roughly.
Yeah.
That's still, that's a major premium valuation. I mean, there's a lot.
And that could be on adjusted earnings too. It looks like that would be adjusted
earnings as well, right? So, premium valuation, a lot of expectation baked in, not a lot of flexibility to disappoint.
It's a good business in a unique niche, and it may be one of those that could be a takeover target over the long term, but we're not going to buy it just on speculating on a takeover. They certainly, they've grown revenues at a high rate. They've grown the share count significantly, like we said, too. So you really have to, you grow those revenues to produce per share cash flow that increases over time. They're going to have to really ratchet up margins and produce better cash flow. That would get us more interested. Good top line growth, a little more spotty cash flow growth, and we'd like to see that follow the top line growth at a better clip and more consistently over time. Again, we have talked with management in the past. I think they are well run. I think they've done a reasonable job at growing the business. The share price has done reasonably quite well over that period of time where they've been executing acquisitions and now growing organically as well. But it is expensive on a cash flow basis. We want to see, like Aaron said, likely a discount to some larger players, not necessarily in the industry or the market overall, and then buying a good business, reasonable price. And right now, good business, we'd like the price to be better to be buyers of this company. All right, we can move on to our next Your Stock, Our Take. Aaron's going to take a listener question or a viewer question on Palantir Technologies. You've talked about this company in the past, I believe, Aaron, as well. It's an interesting business, certain. They did break into profitability, I believe, and are promising that for the year. But you tell us whether it's on an adjusted basis or, there has been high, I believe, stock-based compensation in this business in the past.
Yeah, and that's what we've discussed about Palantir before. Yeah. It has been on the podcast, but not as a Your Stock, Our Take. It was on the podcast when we
reference to stock-based.
What in some ways could be construed as the rampant misuse of stock-based compensation amongst software technology companies. Maybe saying misuse is a bit of an exaggeration, but certainly it's a major, for many software companies, it's the largest expense that they incur on the income statement, yet they completely factor this out in the calculation of non-GAAP or adjusted earnings. But we'll get into that in a little bit here. Certainly an interesting company. I like the space. So Palantir Technologies, PLTR on the NASDAQ, trades at about $9.50 per share. It's a $19 billion market cap. And what they are is essentially they're an analytics and big data company. So they help their clients, which include government agencies and defense and intelligence, and also corporate clients, generate insights from large data sets and intelligence from large data sets. Now, the company just IPO'd not too long ago. It was in September of 2021. So they IPO'd essentially when the technology space the software space was almost at its peak. It was approaching its peak before the big downturn that we saw towards the end of 2022. So at one point, shortly after IPOing, Palantir achieved a share price of $34. Since then, it's been pretty much a downhill ride for investors, along with the rest of the technology sector, I will add, declining about 72% from its all-time high down to the current level. Now, the company did release their Q1 financial results just recently. Pretty good results on face value. So revenue up 18%, non-GAAP operating income up 7%, and non-GAAP EPS up about 150%. So when we look at these numbers, certainly, not impressive growth in the non-GAAP operating income, but earnings per share, that looks impressive. Revenue looks all right. But herein lies the issue that we've faced with not just Palantir, but with a lot of software technology companies, is there's a major difference between their non-GAAP or adjusted operating earnings and earnings per share and their GAAP-based or accounting earnings per share. And whenever you see this big difference, you need to take notice and figure out what is causing the differential. So non-GAAP operating income, 125 million, non-GAAP EPS, 5 cents. But if we look at the unadjusted numbers, we have GAAP operating income of 4 million compared to 125, and GAAP EPS of 1 cent compared to 5 cents. So this is the second quarter in a row in its lifetime as a public company that it has reported GAAP earnings. In the past, when we looked at it before, we saw these big numbers with respect to non-GAAP EPS, non-GAAP operating earnings, but negative values when we factor in other expenses that they're ignoring in the non-GAAP adjustment. So really, when we look at the operating income here, 4.1 million, it actually doesn't look that profitable on a non-adjusted basis. So there's a couple things that I want to break into here in the numbers, kind of tear apart. So the first thing I think we're going to talk about here is just the difference between the GAAP and the non-GAAP profitability. And I already know what it is. I alluded to it before. It's this expense line item called stock-based compensation, which is extremely common in the software technology space, oftentimes being the largest expense that the company incurs. And this is essentially paying their employees in stock or stock options instead of in cash. So this was a great thing for employees when the stock prices of these companies were going up at historic rates year after year after year. Over the past year and a half, it's not been so great, as in most of the technology sector, we've seen a major collapse in share prices since the peak, which again was in late 2021. Now, if we look at stock-based compensation for Palantir relative to revenues, it's 22% of revenues. So this is a very significant number. It is not their largest expense anymore, but I believe when we were looking at the company previously in our stock-based compensation segment, this number was upwards around 50% or more of revenue. So it was a major expense. Still is a major expense, but it's come down a lot. And then one of the issues that we discussed as well, just with respect to the overall software technology space, is does this underestimate the company's expenses? I mean, if they're used to years and years where they're able to pay their employees in stock and then factor that expense out of the earnings figure that they present to the market, what happens when all of a sudden employees start saying, you want to know what? I don't want stock anymore because the stock price keeps going down or it's just not going up. I want actual cash. So as this potentially happens, this is obviously increases the cash expense for these companies. Now, I don't think that we have necessarily seen this happen yet, partly because there's been a lot of layoffs in the space. So maybe employees have less bargaining power right now, but it could be an issue in the future. It is certainly one to look at. There is a major argument or debate in terms of how stock-based compensation should be handled. Some people say just ignore it. Some analysts say just ignore it. It's a non-cash expense. Others say, no, this is an expense. because it results in more shares outstanding. Warren Buffett is on the side of the fence. He says you have to just consider this a full expense. You cannot remove it when calculating adjusted earnings. So this is up for debate. But what I will say, and I think that this is a prudent approach, is when there is a significant, substantial difference between the GAAP profitability and the non-GAAP or adjusted profitability, you have to take note. And it's easy, but not advisable just to ignore the one of the biggest expenses on a company's income statement. So here, major impact on the financial results. But there's another thing that I want to break out here as well. And that's if you look at the GAAP results here, operating income, GAAP operating income, 4.1 million, but GAAP net income, 19.1 million, right? So you would generally expect from an operational perspective for net income to be less than operating income because it's lower on the income statement. And when it's higher, a lot of the times there's non-cash, there's non-recurring items that are adding to that. Sometimes things that you do have to factor out in order to get a real economic assessment of true profitability. But certainly you need to know, I mean, that's unusual that net income is higher than operating income. So we need to dig in, we need to figure out why. Now, the reason why for Palantir basically comes down to interest income. So Palantir has an excellent balance sheet. They have about 2.6 million in net cash, maybe 2.9 million in total cash. Interest rates have come up, so they're now receiving interest payments on that cash balance. Interest income for the quarter was almost $21 million. And that's really what has caused the GAAP profitability, not the operations, but the interest income. Now, a lot of people will say, but Aaron, isn't this a good thing that they have a huge amount of cash on their balance sheet? Absolutely. The balance sheet of Palantir is pristine. That cash, I believe, generated largely from their IPO. But you still need to separate operating profitability from non-operating profitability. And interest on a cash balance is non-operating profitability. If they invest that capital, which we hope that they will at one point, if they invest that in assets that are generating the same return as their current operating assets, then you're not going to, at making that assumption, you're not going to get great profitability at the end of the day. You're going to get less interest income, and their operating business clearly is not that profitable on a GAAP basis, right? So this is something you have to consider. It's great that they have this net cash balance sheet. As I said, about 2.9.
And you meant 2.6 billion, right?
2.6 billion in net cash, about 2.9 billion, I believe, in total cash. About 260 million in lease liabilities. So that's net cash per share of $1.26. Pretty significant. But at the end of the day, I don't want to look. This is not a financing company, right? When I look at profitability, I want to see that the operating business is profitable and not just that they're generating interest income off their cash balance. Eventually, I want to see that cash deployed into profitable operating assets. But anyways, moving on, the company did put out guidance for the full year. They're expecting revenue between 2.18 and 2.235 billion. So that would be about a 14 to 17% increase in revenue from 2022. And then adjusted income from operations between 506 and 556, which would be growth of 20 to 32% from 2022. Now, remember again, this is adjusted. So this does not consider the share-based compensation. And they are also saying GAAP net income in each quarter. But if they're only generating a cent or two in GAAP net income, and that is primarily the result of interest income from their cash balance, it's really difficult to look at that and come up with what would be a reasonable valuation. But speaking of valuation, if we were to just take the non-GAAP earnings per share, analysts are expecting about 21 cents this year. That seems reasonable considering their guidance and considering their performance in Q1. At the current share price, that would be a price to earnings multiple of 45 times non-GAAP earnings. This is a premium valuation still. Now, once again, interesting business, but trading at a premium valuation. Our take in the end, we do like the analytics and big data business. There's a lot of potential here. They have substantial work in the government space. I believe about 50% of the revenue is government, 50% commercial. They have that beautiful net cash balance sheet, which does provide them with an opportunity to deploy capital. But they are trading at a high premium valuation. They have minimal to no GAAP earnings from current operations. And this is a concern to us. So our next steps, we'll continue to monitor Palantir. I like the idea of the business. We have no near-term plans for recommendation at this point. There are other SaaS, software as a service, companies and AI software stocks that we prefer right now.
Yeah, that's a good summary. I mean, the company, like after its IPO, traded in the $20 to $30 range for an extensive period. So it's come down significantly. Again, it's a case of a company that was just trading at silly valuations at those levels, trying to get to profitability. But is there really true profitability there if the major GAAP EPS is really just coming from interest income, right? So the business
I found that
is breaking
interesting,
even.
and that is
basically
going to be the case. A lot of software companies have big cash balances.
Huge cash
balances.
Some
from free cash flow, others from raising money in the past when their valuation was higher. So that's good.
It's better if it's from free cash flow, but if it just came from, the initial IPO in a silly season time, like they're just it's milking a cash hoard there that they didn't even create, right? But I mean, obviously this company has revenues and had growth, but I mean the growth is still there. But you look at it, I think in the next quarter they're guiding towards 12% revenue growth. That's the slowest rate as a public company in its history, and their growth peaked out in March 2022 at about 57% like quarter year over year growth in their quarter then in that March quarter. So it's really come down significantly over that period. And I mean, that's why I don't know if you should pay 45 times that's non-GAAP earnings, right? Like that's a high multiple still, even if it is progressing and moving towards profitability. But like we said, it's really breaking even without that interest income. So, and I did read some other analysts' take on it, and one of the takes was that there was noted that some of the revenue outperformance in the quarter was driven by some special purchase or SPAC companies that went out of business, and the revenue was prepaid and pulled forward as a result of bankruptcies. So, it's a concern there if some of that revenue is not going to continue if those companies went bankrupt, clearly. So it does seems that revenue growth is declining, and we'd like to see it increase.
One last comment I'm going to make here, and this is just to kind of, explain my perspective on why I'm not really that impressed by them making so much money off of their interest income. And that's that, if you look at their cash balance and you look at their interest income, they're generating a return of about 3% off of that. Well, if I'm paying 45 times earnings for an asset, I don't want a return on assets at 3%. I want a solid double-digit return, well into the double digits, right? So that's good that they're generating some cash off of it right now, but it's insufficient. You want to see that capital invested eventually. Now, I'm patient as an investor. I believe in being patient. When companies have a lot of capital, you don't want them to rush out and invest it into something stupid, but eventually you want that to be invested into a high returning asset.
Okay, well, let's move on to our next. Unless you guys had something on Palantir.
I was going to say thanks for covering that for Rom. He did send in a Facebook message, and he asked exactly that. They had 2 profitable quarters recently, and wondering if the valuation is high or low. You answered it perfectly, so I'm sure he'll appreciate that.
Yeah, it breaks it down to, you broke into profitability, but if you're still trading at a massive multiple to that profitability, and a good deal of the profitability is not really coming from operations. So, I mean, that's something to definitely consider. So Brendan's going to take a look at Alexandria Real Estate Equities, Inc., ARE, or just R on the New York Stock Exchange.
Let me share
Take it away, big guy who doesn't visit his mother for Mother's Day.
Brennan spent an hour on the phone with her. Leave him alone.
He's never going to live this down.
Okay, so this question came in from Jack, who is a current client, via email, and he said, curious about Alexandria Real Estate Equities REIT. It has a long-term debt at a low interest rate, long-term occupancy with over 90% of space occupied, and apparently there was a recent large percentage rental rate increase, and both Motley Fool and Zacks recently singled the stock out for it being a bargain. So we'll see if it is potentially a bargain here. So Alexandria Real Estate Equities Inc., ARE, on the New York Stock Exchange, currently trading at a price of around $120 per share, a market cap of $20.7 billion, and a dividend yield of about 4%. Now, it is an office REIT focusing primarily on the life science and biotech markets, and the stock was essentially cut in half over the last year. Now, I wrote year to date in the intro that I sent to Ryan just to prank him, so he would say year to date, not year. Just kidding. I made a mistake. Whoops. The stock was cut in half over the last year, not year to date. Sorry for making you look bad, Ryan. Okay.
You only make yourself
Exactly.
look bad. Don't
At least
worry.
I'll, admit it. Okay, so looking at the actual company, so Alexandria is an owner, operator, and developer of collaborative life science, ag tech, and advanced technology campuses in AAA innovation cluster locations, including the Greater Boston, the San Francisco Bay Area, New York City, San Diego, Seattle, Maryland, and its Research Triangle. Now, the company has about 850 tenants and an asset base in North America of about 75.6 million square feet as of March 31st, 2023. So Alexandria claims that its differentiation is the cluster model in life science, ag tech, and advanced technology campuses that provides its tenants with highly dynamic and collaborative environments. And as you can see here, I put up on the screen just what their Seattle cluster looks like. So essentially, they have a cluster of buildings which they are renting out to companies that are in this ag tech life science, and essentially the key is to have them kind of work together and benefit off of each other. And just as a last note, Alexandria also provides some strategic capital to transformative life science, agri-food tech, climate innovation, and technology companies through its venture capital platform. And as of March 31st of 2023, the company had about $1.6 billion in investments on its balance sheet. Now, let's actually get into the financials here. So the most recent quarter was Q1 of 2023. Now, total revenue was up about 14% to $700.8 million from about $615.1 million in Q1 of 2022. And the growth was primarily driven by strong rental rate growth of about 48%, which represents the highest quarterly rental rate growth ever in the company's history. Now, same property net operating income growth was about 3.7%. Adjusted funds from operation per unit was up about 7% to $2.19 in the quarter. And as of March 31st of 2023, Alexandria held about $1.26 billion in cash and debt of about $11.6 billion, providing a net debt position of about $10.3 billion and a trailing net debt to AFFO multiple of about 8 times. And as Jack mentioned in his email to me, the company's long-term debt has a weighted average interest rate of about 3.7%, and essentially all of its debt is fixed rate with no maturities until 2025, and a bulk of the maturities taking place after 2027. And quickly looking at the valuation, it trades with a trailing price to AFFO multiple of about 14.5 times. And I did take a look at the recent conference call transcript and just a few forward-looking comments that management made. They said, in response to the uncertainty and volatility in the markets, management made a strategic decision to reduce 2023 construction spend by about $250 million. Now, they're still going to spend $2.7 billion in the year. As well, they are also looking to allocate about $225 million for acquisitions throughout the year. And about 95% of its leases contain contractual annual rent escalations, approximating about 3%. So looking at the actual guidance, or looking forward at the company's 2023 guidance, management anticipates to maintain about 95% occupancy and have rental rate increases of about 28% to 33%. And AFFO per unit is expected to grow approximately 6.4% to $8.96. And this would equate to a forward price to AFFO multiple of about 13.4 times. So to conclude here, I think that Alexandria is a relatively attractive REIT, but I'll let Aaron be the judge afterwards. Especially a company that's operating in the office REIT space. Now, it pays a decent dividend yield and has a reasonable payout ratio. It also has grown that dividend considerably over time, where it paid an annual dividend of about $1.40 in 2010, and that is now to a forward yield of about, or dividend of about $4.84. So they've increased it substantially since 2010. Now, the company has also produced good AFFO per unit growth over the last 9 quarters and is projecting for about 6.5% growth in 2023. And while it trades at about 14.5 times trailing and about 13.4 times forward AFFO, I do not think that the valuation is unreasonable for this growth rate. Now, I also think that the company's balance sheet is relatively attractive, given that a majority of its debt is fixed and it has reasonable leverage ratios. But yeah, I don't think that it's a bad REIT overall, especially for a company operating in, the office REIT side of the industry.
Yeah, definitely a specialized name in the life sciences space. You mentioned reasonable leverage ratios. Do you have those offhand?
Yes. So I believe I said, so it is, 1 second here, 8 times net debt to trailing AFFO. And then management is guiding, if I go over here, management is guiding to a net debt to adjusted EBITDA multiple of about 5.1 times. And that's by annualizing their Q1 results here. So, what do you think?
Right.
What do you think about that? Like 5.1 times net debt to adjusted EBITDA.
Yeah, I like it.
Yeah, not too bad.
Yeah,
eh?
for a REIT. Yeah, assuming that it has good clients, which I mean it seems it does. No, I mean I like it. It has a nice yield. Payout ratio is good. It's got some growth, some same property growth, some development growth, valuation. What was that, about 14 times AFFO? Looks okay.
Yep, trailing.
Looks decent. Specialized. I mean, it's an opportunity to invest in the life science space. I'd need to look further to actually say if it's a recommendation or not. But I like it.
Yeah, it's not bad
so far.
I guess my one thought too is, and I'd have to dig in and maybe look further, is, Jack is right that they are planning on increasing rental rates significantly. As you can see, rent rate increases for the 2023 year are supposed to be 28 to 33%. How long can they continue to push that kind of growth on the rental rate? I'm not sure. I'd like to dig further into that. Is that just kind of a 1-year thing? I mean, even as they were saying, in the recent quarter, the growth was primarily driven by strong rental rate growth of about 48%, which represents the highest quarterly rental rate growth in the company's history. How much further can that kind of growth go on, I guess, is a question that I would pose.
Yeah, for sure. I wonder if they're affected at all by their office rates, people, not returning to the office as much and work from home type trends. I mean, it may be improving for them, people going back, right? And so just that's something to maybe track.
That's another
there.
interesting
I did also
science. There would be less of that because a lot of that is research.
Yeah, it's a lot of
You would
labs
think,
and stuff where you actually have to kind of be. But it's a good point.
You need a clean lab or something. It's hard to do that at home. But there could be support staff or something. It may be I'm not sure. Yeah, I'm not sure how that would affect
the office REIT space is definitely not my favorite. But this being a specialized, more of a niche player, it's certainly.
Yeah. And I did like how Brendan mentioned the word cluster a lot. It was
what
really
did you just call me? Did
fun
you just
to hear
call me
Brendan
Brendan?
say cluster. What's your name, Brenda? Sorry, Brendan. Yeah, I don't even, let's be honest, I never get
I doesn't know any of our names. So
I don't even know anybody's name. Okay, well, now we'll transition from Brenda to Brett,
Correct.
Right? I think I got that right.
I think it was
Brendan to Brett. That's why I say Killer Bees. Then it's easy, right?
he remembers one name instead of two. He doesn't remember.
Well, ever since we went to the World Outlook and Brennan's name was Brett.
Yeah.
On his name tag, they provided him with Brett
Habetler.
Habetler.
Yeah. Brett Habetler.
I say Habetler.
Just like you say Saskatchewan.
I'm just,
Anyways,
it's Saskatoon.
Saskatchewan.
I don't even know
Anyways.
which is which.
Fire away.
Okay, let's just let Brett go with 23andMe and figure out if they've isolated the stock picking gene.
No, that's a segue. But we got a question from Bale via email on 23andMe, wondering about the value of their genetic data. 23andMe, symbol ME or me on the NASDAQ, currently trades at about $205 a share with a market cap of $940 million. Founded in 2006, 23andMe is a consumer genetics and research company. The company has built the world's largest crowdsourced platform for genetic research. The company became public through a SPAC in 2021, where it's fallen about 80% since. First, let's look at the financials for Q3 2023. Revenue came in at $67 million, an increase of 18% year over year, but this is primarily due to their acquisition of the telehealth service company Lemonade. Not lemonade, not the drink, Ryan, before you start to try to drink a company.
Damn it.
The company still had an adjusted EBITDA deficit of $43 million compared to a deficit of $64 million the prior year. So less of a loss, but still a big loss. 23andMe continued a streak of net losses on a GAAP basis. For the quarter, the company had a net loss of $92 million compared to a net loss of $89 million in the prior year, so relatively flat on GAAP loss year over year. But on a more positive note, the company does have a massive cash position of $432 million. That's roughly 46% of the market cap. But they also had net cash used for operation of $120 million for the first 3 quarters, so 9 months of fiscal 2023. This also includes a one-time payment from GSK to extend its exclusive partnership with 23andMe for research, and that was $50 million. So if they didn't have that, obviously it would drop quite a bit, but they are working but to earn that cash, but it's a big payment for them, and if they obviously didn't have that renewed or extended, then they would have had probably quite a bit more burn for the period. So with its current operations, value just isn't being created for investors. The company's management knows this, which is why they're looking to leverage its genetic database by integrating it with telehealth services. That's where they brought on their Lemonade acquisition. Effectively, they want their existing genetic testing to give customers a profile of disease that they are at risk of. Then they integrate those results with the telehealth and then pharmacy services. So they're trying to create that one next level. Go from one that you identify the issue or a potential issue, you go to this is an issue, and then they go to the treatment. So, but as of right now, they don't really seem to be creating any synergistic relationship as far as revenue growth right now. Like I said, the acquisition was just the add-on, or the revenue growth was just to the add-on of the existing revenue. And when asked about cost synergies in the last earnings call, management gave a non-answer of saying the two companies are complementary and their focus is on increasing value for the customer. So in reality, they're unlikely seeing cost synergies after that answer. However, they are involved in research leveraged by their data in help of the development of treatments for diseases, which it currently accounts for about 20% of the revenue as of last quarter. All the revenue in this segment comes from their GSK partnership, which started in 2018 and ends in July after their extension. That's where that 50 mil came from. And this obviously, once this ends, their revenue from the segment could alter significantly for better or worse, but management isn't commenting on it right now, as they cannot, since the potential partnerships cannot be commented on until the exclusivity period. So investors are really in the dark for this. However, there is the blue sky opportunity for the company if the success of its treatment derived from its genetic database. The company currently has a notable treatment in development, an antibody treatment that targets CD200R1, a potential cancer treatment, and is currently in phase 2A of clinical trials. If successful, the company could be extremely lucrative, or the drug could be extremely lucrative for the company, but it still has significant and many hurdles to surpass, and it may never materialize. As well, they could potentially receive royalties from GSK 608, which they helped initially develop, but then they didn't want to keep on incurring operating costs. So they elected into an option of taking royalties, and they don't have to pay for the operating costs as it's developed by GSK, and that's currently in phase 1. The company's core asset is its data, and it could be at long-term risk. 23andMe uses genotyping for its analysis as it's cost-effective for consumers. That makes sense. They started in 2006. At the time, gene sequencing, which is superior as it does you can do the full human genetic information, was about $10 million a test. Yes, 10 million. And now that's down to about 500, depending on who you're looking at. So you're looking at a exponentially lower cost to do this better test. And obviously, if you're looking at the research market, they might want these full genetic results. So it could potentially, if another company starts to build up a large enough database, it would have more depth than 23andMe. They have a wide spread. They have about 14 million users, but they do not have the depth of what modern gene sequencing could get. Overall, the company just does not fit our criteria. Simply, it's not near profitability. It's burning cash quarter over quarter at this time. Its current bullish thesis is about the same as any biopharma company of if the treatments can make it to market, if they can scale their treatments, it could really see a blue sky potential. But they're going to see many of those and many, many more fail than what do succeed. So, and then of course you have the risk of if their database starts to lose value, if other competitors come in, gene sequencing comes down, they're on an outdated to the point technology. It's just not something that's really creating value at this time, and there's a lot of risk. It's just not something we really invest in at this time.
Yeah, it's certainly interesting. Just, I mean, looking at that chart right now, how much the price has come down over time too. I mean, it's probably good that it's come down for sure, but yeah, I mean, the company just doesn't meet our criteria right now. I mean, I don't know if anybody has anything else to say.
It's interesting that they're like getting
there.
into like the royalty side of things or trying to develop drugs, using like built off of their data. It is interesting how they're trying to monetize that side of the business, because that was going to be
the cash burn right now is really significant,
for sure.
Though, even over the first 9 months. It's got to come down.
Optionality.
Else,
who knows if
at some point they'll have to
raise. And who knows if any
Exactly.
of those drugs will take off. So I mean, again, it's as much as people on the internet are going to be saying, Brett, you don't understand these drugs. You don't know them, buddy. I know.
I don't know the product. I don't know the drug. I don't know the potential. That's normally what we hear from these sorts of things. And of course they can. We're not saying that they can't have potential, but we're saying the risk outweighs the current potential reward. So down the line, let's say these drugs start to make it to market, we might consider them at that point if we see them being potential for investment, because we're looking at this from an investment point of view, not just a product point of view.
Right. And then as well, when you look at the financial analysis of a company like this, our perspective is that if the product or the service that they provide is a tangible product and service that is actually providing value in their particular industry, then they should be able to sell it and they should be able to generate revenue from that. And ideally profitability to the bottom line. If a company isn't generating revenue, nobody knows the commercial viability of that product or service. That's just a fact. Some of them may go on to generate revenue. Many, perhaps even most, will not. And so until the company is actually producing revenue, there's no point in pretending that you know a lot about the product or service, especially if it's something that's highly technical. Most of the people that feel that they have a good sense of the commercial viability of a product don't. It's an emotional attachment that they have. They want it to be viable, or something has been said, or they've learned something about it that encourages their thinking towards it being viable. But as much as we want to believe in something that could be revolutionary and create like huge profit in the portfolio, the first step is to actually see, do the experts in that particular industry believe that it's a worthwhile product to purchase? And if they do, then they have purchased it and the company has generated revenue. The company's pre-revenue, you just don't know.
Yeah. I mean, often you see investing, people buy the stock and then they get a massive confirmation bias. Every little piece of information that they see that confirms what they want for that company, they just, believe that blindly. And it's something that actually can lead to significant losses over the long term. That's what I have seen. And it can be something that you should avoid. That's why we always hear too, well, once it gets revenue, once it gets profitability, well, then you've already missed out. From what I some of the best stocks that we've ever recommended had profitability, earnings, revenue, and growth when we initially invested in them. And they had, I mentioned 4 of them today. All of them had 10x times growth after that. That's what everybody's looking for when they buy a blue sky type story. But you don't have to have the downside risk that some of these companies
you got
have.
the proof of
That's
concept
what you're really
with,
looking for.
you know, but with waiting a little bit, you know, being patient.
Yeah. Okay, well, that'll close out our show this week. I'd like to encourage everybody to go, if you're watching this on YouTube, smash that subscribe button. If you're listening to this on iTunes, go there, rate and review us, and we'll continue to provide that content on a weekly basis. Ask us the questions for our Your Stock, Our Take segments, or if you want us to talk about any financial topic or issue, send those questions in any way you can get in contact with us. And as always, I'd like to wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.